CBOE out in Chicago. So, Pat, we're seeing a little bit of a sell-off today after a gain yesterday following the Fed's statement. What are options traders making of the Fed sort of opening the door to a December increase?
Well, a little bit of what we've seen is there's definitely concern of a increase in the rates now. The likelihood's gone to about 50% that we will increase in December. What we saw a little bit yesterday after the announcement, and then a little more of today, is we've seen put buying further out. Basically, we've seen some buying of puts, basically 15% on the money in March of next year. As a trader, what that's telling me is that people are now concerned that if the Fed does rate, that we could see some a pullback in the market after the possible increase.
And is that a change? I mean, because one would think that that perception would have been out there. Maybe it's just the timing that has changed at this point in terms of what people are buying.
Well, the likelihood of the increase in rates, it went up yesterday. I think prior to the announcement yesterday, it was about a 35% chance. It went up to 50. It's a fairly significant move. I think it was enough to rattle some cages and got people concerned that they may want to run out. They might want to buy protection. A great place to go and do it is in some of our broad-based indexes like the S&P 500.
And so that's the trade you're recommending as well. Get specific for us. What trade exactly are you looking at?
Okay, so basically my trade is for if somebody's is long stock currently, in particular if you're long, say, the S&P 500. I am a bull right now. I do remain bullish, but I'm pretty cautious right now. I can definitely see if they increase rates that we have some sort of pullback. So what I would like to do is I would like to go to the December 31st and buy the 1875-1975 put spread. You're going to have to pay about $11.50 for that put spread. Essentially what that does for you is if you're holding a long basket of stocks or you have a long portfolio, you're going to buy yourself some protection if we see some sort of pullback in the market right now or coming in towards the end of the year. You're going to pay about 0.5% of premium to your portfolio to get it, and it'll buy you 4% of protection if we would see the market pull back somewhere towards our August 24th lows.
And Pat, you mentioned... I was just going to ask about the pricing of that, because you said it is getting more popular now following yesterday. So is it a pretty pricey trade on a relative basis?
Well, actually, it's not that pricey right now. What we're seeing with the VIX is it is up today, but relatively speaking, it's currently under its 50, 100, and 200-day moving averages. So relatively speaking, the VIX is a good gauge for pricing for protection.
Gotcha.
The higher the VIX is, the more expensive it is to buy insurance on your stocks, essentially. Okay. So with the VIX trading at a relatively low level.
Got to leave it there. Thanks, Pat Kernan of Cardinal Capital. We'll be right back.